Hello, my name is Valentin Khokhlov. I'm a CFA charter holder, and actually, I first created this investment club in Russian, which is my native language. But some of my friends with whom I studied in London Business School asked me, "What is this thing about? We don't speak Russian, but we are interested in what you are talking about. Please make something in English." So I decided to create an English version, which probably would be a little bit shorter because I will not cover everything in much details, as a post-Soviet audience is much less literate in financial instruments and topics. So I probably would discuss less in the English version, but key concepts or portfolios or observations I will try to keep here, but not all the kindergarten stuff that needs to be explained for a post-Soviet audience and will be included in the Russian version. So let's start with the idea why I decided to create this club. Actually, almost 10 years ago, it was my idea to create a wealth management boutique, because wealth management here in Ukraine is totally undeveloped. At the moment, maybe one or two boutiques exist, but 10 years ago there was none, and I thought, well, it's an interesting niche, and why not do it? So I developed several investment strategies. I learned much about how to establish the processes, how to find a broker in the US, how to transfer money, and how to explain investors what is the difference between bank deposits, which was the only instrument used for savings in Ukraine before. So basically everything was developed, but failed to attract customers because of regulatory restrictions which prohibited Ukrainian citizens to invest abroad at all. There was one grey scheme called offshores, which was basically legal, and even I got a reply from a broker, from actually one of well-known brokers, investment brokers, and they told me that they work with offshore companies, no problem. So, but still, I did not create any actual portfolios, just model ones which exist for more than 10 years. They were started. The inception date was March 1st, 2010. So now it's simpler, so that's why I decided to create this investment club in Russian, because people might need these services and might need wealth management providers such as myself. So back in 2011 I entered CFA program to support my credibility as investment manager, and to also to tell that I'm not an unknown guy, but I am a member of a credible professional community, and I adhere to high ethics standards. So I'm a trustworthy person, and basically I have a certificate, a charter that both confirms my experience, my skills, knowledge, and also my commitment to ethical standards. Basically, so I passed all 3 levels of CFA examinations in 3 consecutive years, and became a charter holder in 2013. And that year I also had one side project with a hedge fund based in United Arab Emirates in Dubai. Actually, one of my colleague, Eric Nyman, was hired as chief advisor, and he hired me as associate for that project, and my role was to develop portfolio management strategies and also hedging strategies and risk management. So basically, we can talk about Islamic finance in one of our streams as well. But as I failed to attract clients, I switched back to corporate sector. I was hired as senior manager to one of the largest FMCG corporation, and ended up managing a business unit of that corporation. And as more relevant education, I entered executive MBA program at London Business School, which I graduated from in 2016, and in 2018 I became board member at CFA Society Ukraine, which is the Association of Investment Professionals here in Ukraine, and part of CFA Institute, which is the largest professional association of investment professionals. So more than 170,000 professionals all around the globe. And what I do, there are free study courses, valuation workshops, and basically one of the presentation at our recent workshop was about portfolio management for individuals, which is exactly the same idea I had 10 years ago. So I decided, well, maybe now it's more demanded. So basically my experience from my personal observation, talking to different people, looking at how they invest, how they approach investments, one of type I've seen are idea-driven investors, persons who have idea, one or several ideas, typically a few ideas. For example, a person may believe in sustainable energy, and it's a good choice then to invest in a company producing solar panels, for example, because that company should benefit from increased demand. If you believe sustainable energy will be in high demand, this company should go up. Basically, the stock should grow. These idea-driven investors typically have a long time horizon, because ideas, they will not materialize in a year or 2 years. Typically 5, 7 or even 10 years horizon. You need to make some investment and wait, basically. And usually those guys have several ideas, they put equal weights to each idea. For example, 4 ideas, let's have 25% of my portfolio invested in idea number 1, idea number 2, idea number 3, and idea number 4. Very simple. So their key feature is ideas. They gamble on ideas. It's like intellectual gambling, because unlike the casino, you don't put your chances on a roulette, but you just go for your own analysis and your own mindset. If you are right about how the world would develop, that you will bring you return on your ideas. Basically, those guys don't do much portfolio management. Totally different guys who believe in technical analysis. You can tell those guys from other investors, because they look at charts, at candle charts, candle bars, and they put different lines, support levels, figures, shoulders, triangles, and all that stuff. They try to catch the trend. And typically very short lasting trends, they often associated with day trading. So basically buy some instrument, not only stocks, forex, foreign currency exchange, or oil, or futures, options, whatever, buy and then fix the profit or fix the loss, and that's it, all within a very short time frame. they don't dig into deep analysis, they don't do portfolio management typically, they concentrate on one or two charts they work with. And then third type of guys, totally different again, they believe in fundamental analysis, they believe that each company has some fundamental so-called fair value, and fair value based on thorough analysis of the industry competition, of company financials, of their new products and demand, and whatever analysis you can think about. If you hear about financial analysts who produce investment reports, those are the guys who prepare the raw materials for such investors. So basically they analyze a few companies in depth, and they create portfolio of those companies, typically very simple portfolio with equal weights gain of the companies they choose, or very simple weighting schemes. And all those analysts, or most part of those analysts, they have 1 year horizon, so they project the stock price 1 year from now. And they generate very simple advices: buy, hold, or sell. That's it. And you as investor, you decide how to create this portfolio. Very simple rules. Fourth type, those guys, unlike all the other types we have discussed before, those factor investors, they create a portfolio. So here we start working with a portfolio, and they create portfolio with a different, with a given sensitivity to various risk factors such as interest rates or oil prices or inflation or stock market index. So different risk factors, and they calculate what's called factor betas, sensitivity coefficients, and they have mid-term horizon and build very complex multi-factor models trying to adjust their risk appetite to the factors and create a portfolio suitable that matches their risk appetite the best according all the dimensions of the risk. And finally, what I call classic portfolio management, the portfolio theory which developed in 70s, in 80s, started actually with Harry Markowitz, who got Nobel Prize for his portfolio theory, portfolio model. And basically what I do, I based my strategies on Harry Markowitz's work and his successors. It's basically one factor model. It has risk as volatility of returns, and it has returns, and it has a trade-off between the risk and the return of the portfolio. Or there may be a variant that uses market beta, which risk factor sensitivity to single risk factor. Also, mid-term horizon, typically one period model, and period is 1 year or quarter. And unlike all the previous investors, those guys, they do use some optimization models. They optimize the risk return of over the set of securities to create an optimal portfolio. And there, the key feature is very sophisticated in terms of weighting of different securities in the portfolio, even if they don't dig deep into each of the companies present in the portfolio. So the key instruments are stocks, basically share in the company. It has voting rights, it has right to get dividends from the company. Basically, I think you all know this instrument, no need to discuss in details. ADRs is a more tricky instrument, because suppose you want to buy a German stock, for example Siemens, which is not listed at the New York Stock Exchange. There are some companies that have dual listings, for example, in Frankfurt and New York, or in Paris and London. But let's suppose it's not the case. Of course, you can buy euros. You can go to your broker and say, well, do you work with European exchanges? And many brokers do. So you basically put euros into your brokerage account, and you give order to buy stocks in Frankfurt, for example. But the trade-off is you need to have a multi-currency portfolio, and you need to pay higher brokerage fees, because those brokers, they have lowest fees for the US stocks, of course, and US market is the most liquid. So European markets less liquid, less familiar, higher brokerage fees. So there's another possibility. Let's suppose a bank buys 1 million of Siemens stocks for euros in Frankfurt, and put those stocks into the depository. And against each of stock the bank owns, it issues so-called depository receipt denominated in US dollars and put it into New York Stock Exchange or other stock exchange in the US. So basically each ADR, each American depository receipt, equals to a stock, because it issues it to free trade. Of course, the stock is ADR as a stock is bought or sold, and price may deviate from the fundamental, but if the instruments are liquid, the market forces will inevitably bring the ADR price to the stock price. Otherwise, arbitrage is possible, and the arbitrage works only on illiquid market or inefficient market. And we can actually see, let me switch to the screen. It's Yahoo Finance website. It shows Siemens on Xetra or Zetra. I don't know how to pronounce it correctly, but it's exchange system working in Europe. So Siemens is listed there. Its ticker is C.D, and the price was 124 euros as of January 8th. And what we have here is called also Siemens, but it has different ticker. It's SIGI, and it's denominated in US dollars. Actually, it is ADR. And you may wonder why is the price is different. Its price is 76.06 US dollars, which makes no sense why the stock was more than 100 euros and the ADR costs 76 US dollars. And we get the answer if we look carefully at the Siemens website, which describes the depository receipt. It says that 2 Siemens ADRs traded in US dollar correspond to 1 Siemens ordinary share. So basically, what we see here, we actually see that the ratio might not be 1-to-1. In Siemens case, it's 2 ADRs correspond to 1 share, maybe vice versa. Maybe 1 ADR corresponds to 10 shares, for example. It makes sense if the share is quoted at very low price, for example $1 in equivalent. And the optimal share price range is considered to be $10 per share to $100 per share. So if the share price in a local exchange is less than $10, it may be worth to create 1-to-10 ratio for ADRs. And vice versa, if the share is very expensive in dollars, the ADR may be a fraction of share. For example, as in the Siemens case, 1 share equals to 2 ADRs, maybe some other shares you have 1 to 10 ratio, so it depends. And the ETFs, many of you may know what is it. Basically, exchange traded funds. Let's suppose you want to invest not in Siemens, but in German economy, German stock market. They have DAX 30 index, which composed of 30 largest companies in Germany. You may, of course, create your own portfolio by investing euros in Frankfurt and buying all those shares. But let's suppose someone, bank or fund or investment firm, buys those stocks, invests $100 equivalent into those stocks and puts them into this in the same weights as they have in DAX 30 index. So basically you have 100 million portfolio which is invested in the DAX 30, and the fund or bank or investment company issues 1 million fund shares. They valued initial value $100 each. So basically by buying this share of this fund for $100, you became invested in the whole DAX 30 portfolio, and each of the shares behaves like that portfolio. So basically you don't need to put a significant amount of euros and to have 30 shares in your portfolio. You can just buy one ETF stock, and actually there are such ETFs that invest in different countries. And of course it started not with Germany or Italy or United Kingdom. It started with the US market. So instead of buying 500 US stocks to create a S&P 500 portfolio, you can just buy one ETF stocks such as SPY ETF, and you became invested in such a diversified portfolio. It actually started in 1993, as far as I remember, with this SPY ETF, which replicated the S&P 500 portfolio, and quickly other ETFs appeared tracking other indexes, Dow Jones or Nasdaq Composite, or more like diverse indices, and then bond indices, and then other instruments. So for example, the bank may invest $100 million in physical gold. It can buy gold bullions and put it into its depository and issue 1 million of shares for that gold bullions. So by buying these shares, you can become invested into physical gold actually, without buying physical gold, which is not a very liquid investment, and without buying some storage for that gold. So you have the same exposure to risk and return as when having physical gold, but you just have ETF shares of such ETF called GLD for silver, SLV. So basically you can easily become invested into precious metals. And other commodities you can now buy with ETFs as well. So you don't have physical commodities, but you have the same risk and return exposure as by holding those instruments. And now we have a large variety of ETFs. Actually, I think we will have a separate stream dedicated to different ETFs and what they are about. And a few words about like my strategies that I developed like 10 years ago, more than 10 years ago. So one of the portfolios, it was aggressive, as I called it, because it was concentrated, it was not diversified. It was created of large cap company stocks, 15 companies I chosen by me from the S&P 500 universe, and the Morningstar style is large cap blend, which means some of them are growth stocks, some of them are value stocks, but all of them are large cap. So concentrated, because from month to month I have one stock or two or three or sometimes 5, 1 to 5, generally very concentrated, not diversified at all. But strategy is balancing its risk and return and using the momentum effect. Again, a specific topic, momentum or contrarian, how you invest, how you choose your variant of the strategy, and we can speak about it in a separate stream. Some evidence of performance of momentum or contrarian strategies. It's an interesting topic, of course. For this portfolio I use mean variance optimization, or MVO, which is acronym for mean variance optimization, and it's exactly the Harry Markowitz theory, and William Sharpe and other people got their Nobel Prizes for it. And rebalancing is monthly, so each month the portfolio is rebalanced, a new composition is created, and within a month it's buy and hold, so it's not changed for a month. Two portfolios called S&P 500 because the purpose is to track the index, but the idea was to create a small portfolio that replicates the index as close as possible by using 5 or 15 stocks. So I have 5 or 15 shares. Again, it's large cap blend, so because each company is a large cap and blend of growth and value stocks there, and the strategy is tracking the S&P 500 total return index. So again, I have optimization model. In this case I minimize so-called tracking error volatility, or TEV, which is a specific risk measure that shows how your portfolio deviates from your benchmark. The benchmark in this case is the S&P 500 index. So the purpose is to create such a composition of the portfolio consisting of 5 or 15 stocks that has the minimal possible risk measure, tracking error volatility, so it's closest to the S&P 500 index, again with monthly rebalancing. A balanced portfolio, again from the US, asset classes, different asset classes in this case, because it consists of stocks, bonds and precious metals. Precious metals are silver or gold, with weights from 0 to 30% of the portfolio. And again, as I mentioned before, I don't buy physical silver or gold, but I buy the corresponding ETF shares. The same situation with bonds, actually, not physical bonds, because physical bonds, it's possible to buy with brokers, but it's tricky. We probably again need to spend one stream discussing bonds and investment in bonds, because it's not so straightforward. In theory it's simple, but in practice there are many nuances, and many bonds are not that liquid actually. So I also prefer to invest to bond market, to a diversified portfolio of bonds using ETFs. I have 4 different ETFs. So one is Treasury, US Treasuries. One is Treasury inflation protected treasuries actually. One is aggregate bond portfolio, both treasuries and corporate bonds, and one is corporate investment grade bonds. So different types of bonds, but each month only one ETF is present. So you get some exposure to bonds from 30 to 70% of the portfolio. Very rarely it's more than 50%. Typically it's 30%, but still exposure to one of the bond ETFs. And the remaining part of the portfolio is invested in stocks from 30 to 70%, and here we have industry diversification, so energy, consumer goods, financials, technology, from 7 to 33% of the portfolio invested in the one industry. And the strategy is again balancing risk and return using the momentum effect with MVO optimization and monthly rebalancing. And the fourth strategy, which I tried, I created such a model portfolio called BRIC, because at the end of the previous decade, BRIC was a very popular concept. Brazil, Russia, India, China, emerging markets, and it was forecasted they would grow faster than the developed markets, which was not the case actually. So BRIC portfolio did not deliver a good performance. Actually, it was absolutely no reason to invest in the emerging markets, because the US market in the last decade was better than any of the emerging markets of their combination. But still, there was such a portfolio called BRIC. It also consisted of US stocks, bonds and precious metals. And the strategy again was risk-return balancing using the momentum effect with mean variance optimization and monthly rebalancing. And the diversification was done in two dimensions. One was per country or geographic. So each country, Brazil, Russia, India, China, had 15 to 35% weight in the portfolio. Not less than 15%, no more than 35%. So that's it. And the balance was US stocks, bonds and precious metals, with metals from 10 to 25%. So there was a floor and a cap on metals as well. And the second dimension of the diversification was by industry, which had three industries: basic materials, 20 to 50%, consumer goods, 20 to 50%, and technology, 20 to 50%. So basically you can have basic materials in Brazil and China, and you can have technology, which is mobile telecommunications, in Russia, and you can have consumer goods such as Tata Motors in India, for example. One of possible combination of both geographic and industrial diversification. The problem also was that for some countries there was a very small amount of stocks, or in that case mostly ADRs, available at the US stock exchanges. And for Russia I ended up with one stock, which is mobile MBT, basically mobile telecommunications. I started with three possible choices, with Wimbledon and Wimbledon and MBT. But two of those stocks were delisted during this period. So the problem is that you don't have a large variety of companies to choose from. But of course, instead of using single securities, you can use ETFs. There are ETFs that invest in Brazil, in Russia, in India, in China, and they represent diversified portfolios, each of them basically. But my strategy was to create a portfolio of single securities, not of diversified portfolios in terms of stocks. I do use ETFs for metals and bonds, but not for stocks. So basically those are my initial portfolios, and I think we will reuse them. We will check the returns and risk measures just to see how it works, how the investors can measure and assess the performance and risk, and maybe how the portfolio theory works using those portfolios as samples. So that's all for today. Many thanks for your attention, and if you like this channel, if you like this project, stay tuned and see you next time. Goodbye.